companies rated by EMEA-Based across Europe, the Middle East and Africa has shown some clear trends. I'm Yvette Essen for EMEA-Based TV and I'm joined by Mahesh Mistry, Senior Director of Analytics, to talk through a recent report we've published looking into some trends. First of all, can you tell me about the building blocks methodology? So EMEA-Based has conducted this analysis based on best credit rating methodology. Let's talk about those blocks. Can you describe them briefly?
Yes, so we have four main building blocks, which are balance sheet strength, operating performance, business profile and ERM. If I briefly talk you through the analysis that we've conducted. So when we're looking at balance sheet strength, one of the main aspects of balance sheet strength is looking at the risk-adjusted capitalisation of the company. And when we look at our portfolio of ratings, most of these are around the 45% level, so well into the strongest category. However, when we have our overall assessment of balance sheet strength, the vast majority of companies are scoring very strong. And that's mainly indicative of when we factor in, say, the quality of assets, reinsurance dependence and their reserve position, which is driving down that assessment. When we consider operating performance, we see across emerging markets and mature markets that it is a bit more stable going across there. But what we find, those which are scoring strongest generally have low loss ratios and combined ratios, very good ROEs and lower volatility over a longer period of time. As we move on to business profile, the distribution of most companies is generally to the neutral to limited business profile. Now those which are scoring, say, favourable positions are those very big, strong global groups which have very good diversified business, not just geographically but by product as well. But as we move into emerging markets, some of those have strong positions in their respective markets. However, when we look on a global basis, they can be relatively small and limited, and the earnings can be quite concentrated to one particular line of business. Finally, we have the enterprise risk management assessment. Only 5% of the population are scoring very, very strong in terms of the ERM assessment, with most of them at the appropriate level. As we look at emerging markets, you find that these markets tend to be in their infancy, and we find that some of the ratings are a lot lower than the appropriate assessment.
So we applied these four building blocks across our ratings in the EMEA region. Can you tell me about that data set?
Yeah, across our office here in London, we look at around 185 ratings which has gone into this analysis. Now you have to remember that this is a very diverse group of ratings that we have, covering not just Europe, the Middle East and Africa as well. And there's a good portion of emerging market companies in this sample set. Taking this one step further, you have, say, reinsurers, insurers, surety writers, to companies, mutuals, P&I clubs. So when we're looking at this analysis, you have to bear in mind the context of the type of companies and the markets that they are operating in. They are not all the same.
You did emphasise they are diversified, they're not all the same, but there were some key trends that did emerge from our analysis. And one of them was that the companies that were well diversified tended in general to produce stronger earnings. Why is that? Yeah,
when we look at our portfolio of companies, there are a number of metrics that we look at, and one of them obviously is operating performance, and the key driver in operating performance is the technical performance that companies are producing. Now when we are looking at our sample set, you generally find those big global groups that have diversified earnings, not just geographically but by product as well, tend to have better results and lower volatility. So if one class of business or one market is affected, then that could potentially be compensated by other classes of business.
Something else that did feature in the analysis was that companies in emerging markets tended to experience more volatility. Was that a surprise?
Not really, because when we're looking at emerging markets, obviously country risk will play a more prominent role in our analysis, where we're looking at the economic risk, the political risk and the financial system risks. And as we know, as we move from CRT 3 into CRT 5, these markets are going to be a lot more volatile and a lot more uncertain, and these are the type of environments that these companies have to navigate in. So when we do look at, say, their earnings and capitalisation, they can tend to fluctuate due to the investment profiles that they have in the market and the fact that inflation, interest rates are high. and the economic and political environments are uncertain.
And when you refer to CRT 3 and 5, you're referring to the country risk tiers, aren't you?
Indeed, I'm referring to country risk tiers.
Okay, can you tell me a little bit about what they're like in these particular markets?
So generally, when we look at our country risk tiers across the markets that we look out of London, you generally have the European markets, of which most fall into country risk tiers 1 and 2, and then the emerging markets would be CRTs 3 to 5. So when we're looking at CRT 3s, it's mainly the GCC countries. As we move into, say, 4 and 5, you're looking at North Africa, Africa, and say the Levant region.
A copy of AM-Best's report looking at trends within the EMEA region can be found on ambest.com. For AM-Best TV, I'm Yvette Esson.